There is a hidden rule inside the tax code, Section 7702, that almost no entrepreneur understands. Yet, this is a rule that can quietly detonate the tax-free benefits inside your life insurance policy without warning. Not because you missed a payment, not because the market crashed, not because the insurance company failed, but because you crossed an invisible IRS tripwire, the MEC limit. And when you cross it, your tax-free retirement strategy becomes a fully taxable liability, instant. So if you're an entrepreneur putting real money, like $2,500 a month, into an IUL, you cannot afford to misunderstand this rule, because the IRS isn't just watching your business, they're watching your policy too. So stick with me, because I'm going to show you the exact mistake most people make, the IRS trap almost nobody talks about, and how one 28-year-old entrepreneur nearly lost millions because of it. We're using real illustrated numbers, the exact math behind his policy. Hello, my name is Robert Balgac. I'm the founder and CEO of Black Swan Insurance Group. Since 2017, we helped over 20,000 families protect and grow their wealth, backed by 800 plus 5-star Google reviews. And our mission is simple. We don't sell policies, we engineer them. We help high earners keep more of what they built, without Wall Street risk and without IRS surprises. And the number one surprise we see is policies violating Section 7702 or 7702A, triggering MEC status. And the client had no idea. So if you want personalized clarity, there's a link below to book your private strategy session with me and my team. But first, meet Eric. Eric is a 28-year-old overachiever. He runs an AI automation agency from home. He builds AI chatbots, sales funnels, email automations, back-end systems for small businesses. And last year, he finally broke through and now is making $25,000 a month in consistent revenue. But like most entrepreneurs, he came to me with the same frustration. He was saying, Rob, I'm great at generating income, but I'm terrible at keeping it. His dream? Retire at 60, and then spend 60 days circling the globe. A modern tribute to Around the World in 80 Days by Jules Verne. See the world before turning 61, and then live entirely on tax-free income. So Eric committed $2,500 a month, $30,000 a year, into a properly engineered IUL from age 28 to 60. But here's where the danger creeps in. If the policy is designed incorrectly, if the death benefit is too small, if cash grows too fast, if premiums violate IRS limits, the Section 7702 and 7702A strip away every tax advantage completely. So let me show you the IRS tripwire that almost caught it. And this is the part most agents gloss over, the part that determines whether your retirement stays tax-free or becomes taxable. Think of the IRS like a referee who never really explains the rules, but still throws flags when you break it. So Section 7702 defines what life insurance means for tax purposes. It requires a certain ratio between cash value and a death benefit. If cash grows too quickly, or if the death benefit is too small, or if the premiums are too aggressive, the IRS says, no, this isn't life insurance. Tax it like an investment. That's called a MEC, Modified Endowment Contract. Section 7702A, also known as the 7-pay test, and this rule determines how much money you can put into a policy during the first 7 years without causing a MEC. It's the IRS version of maximum funding speed limit. So looking at Eric's numbers, at age 28 and up to his first $30,000 of contributions, his cash value ends up being $26,275. His death benefit is around $784,000. 5 years later, cash value at $149,000. Death benefit keeps growing. As the cash value keeps growing, it's now $907,000. At age 37, 10 years after he started the policy, cash value is expected to be around $355,000. Death benefit is $1.1 million. And he's safely inside the IRS corridor. But if this policy was designed poorly, Eric would have triggered a MEC by age 33 without ever knowing why. And the worst part, 7702 isn't the only trap. Most entrepreneurs break their IUL not from underfunding, but from trying to optimize too aggressive. Imagine trying to fill a water balloon with a pressure washer. It can hold a lot, but if filling up too fast and it bursts. So your IUL works the same way. So small business owners always want low insurance cost, maximum cash value, tax-free access, and minimal debt benefit. But if you push too hard, especially lowering the debt benefit, and you collapse the IRS-approved container that holds your cash, you could end up in trouble. Looking at Eric's policy at age 40, cash value has grown to $525K. That benefit is $1.3 million. At age 50, cash value is $1.4 million. That benefit is almost $2.6 million. And these ratios are engineered. And this design prevents him from tripping the MEC wire. And at age 60, his retirement year, cash value is projected to be $3.6 million with a debt benefit of $3.9 million. But none of this matters unless you choose the correct IRS tax definition for your policy structure. Most policies don't fail early. They fail decades later, in years 25 to 45. So let's define these two key terms clearly. GPT, the guideline premium test. This IRS structure limits how much premium can be contributed based on the size of the debt benefit. It is more flexible early, but it has a strict ceiling, and that is best for small, traditional policies. But GPT is not ideal for cash-heavy strategies. For them, we usually use CVAT, stands for Cash Value Accumulation Test. And this structure requires a higher debt benefit, but it allows maximum long-term cash accumulation. It is built for high cash growth, adjusts debt benefit automatically, protects the policy from future MEC violations, and it's best for entrepreneurs stuffing cash into their IUL. So GPT is like a highway with many exits, but tight weight limits. And CVAT is like an interstate built for semi-trucks. Fewer exits, but built to carry massive load. Eric needs CVAT because his cash value explodes later in life. At age 61, his cash value is $3.6 million. Age 70, $8.8. Age 80, $15 million. Age 90, $25.8 million. And age 100, if he makes it that far, it's $50 million in accumulated cash value. All started with contributions of $2,500 a month when he was 28 years old. Crazy now. So what if this policy was designed under GPT? In that scenario, he could have tripped the MEC in his mid-70s, pretty much destroying 40 years of tax-free strategy. But CVAT automatically raises the debt benefit to maintain IRS compliance. It still protects the 0% floor, tax-deferred growth, tax-free policy loans, basis withdrawals, and non-MEC status for life. And now the pay. Eric at age 60, stepping onto a plane with a single backpack. His dream since his 20s, a digital age tribute to around the world in 80 days. But tighter, smarter, and uniquely his. So here's his 60-day route. New York, London, Dubai, Mumbai, Singapore, Tokyo, Honolulu, LA, finishing back in New York. A full circumnavigation of Earth. And just like Phileas Fogg gained a day by traveling east, Eric gains something far more valuable. He gains back decades of taxes he never has to pay. His IUL gives him a 0% floor, tax-deferred growth, tax-free loans, liquidity at every stage, automatic CVAT protection, and $297,000 per year in tax-free income starting at age 61. Not because he was lucky, but because he used the right structure. And high earners don't need more effort. They need better engineering. So if you're a business owner earning real money, but losing too much of it to taxes, if you want your own gain day, if you want a strategy engineer to stay compliant with 7702, 7702A, CVAT, corridor limits, and MEC rules for life, then click the link below, book your private strategy session with us, and we'll engineer your tax-free engine together. Your business builds income, your IUL builds freedom, and remember, it's not what you earn, it's what you keep. Enjoy the ride.